Hi, good evening, everyone. Hi, good evening, attendees. Welcome to our quarterly portfolio calls. So today we'll be covering two of our important portfolios, three series of Golden Decade Fund and India Vision portfolio with Kuldeep. So it's four. We will begin in a minute, and we'll let participants join in, and then we will go to Kuldeep for his insights, and they then take Q&A. So once again, good evening, participants. My name is Sankalpo, and I am based out of the ASK's Mumbai office. Welcome to the call, everyone, attendees, and Kuldeep. So Kuldeep is our fund manager for the Golden Decade Fund, three series that we run, and India Vision portfolio. Kuldeep has been with us at ASK since 2018, and his educational qualifications include a BTech degree from IIT Roorkee and then an MBA Finance from IIT Bombay. He worked with reputed companies such as Tata Motors, HSBC, Capital Markets, and then at ASK, he's been spearheading these portfolios. So we will just take the format for the discussion today will be for the first 25 to 30 minutes. Kuldeep will present his thoughts on the Golden Decade Fund and the India Vision portfolio. And then we will take question and answers from members of the audience. Please feel free to type in your questions on the chat box here. So with that, I will now hand over the floor to Kuldeep for his presentation, and I'll go on a listen-only mode. Thank you, Kuldeep.
Hello, everyone. Thanks for joining in. And before coming to the portfolio, we have to think about, say, ecosystem, the market conditions in which Indian equity market are working as we speak. So whenever we think about, say, any portfolio, any stock, there are three things which matter. One is the global macro situation, domestic macro situation, and the company specific, which we call the micro in the context of the portfolio. If we think about say global macros, currently there is a lot of uncertainties. Many of you would be listening, reading that there are noises related to tariffs, particularly coming from US, and its implication for India as well as for the rest of the world. Given the dispensation change in US, this area still remain uncertain. Everybody is guessing like what would be the final outcome, and the current expectation is that we will be having more certainty, visibility by April 25, the announced date for the implementation of the tariff from the US side. Then there had been concern related to say domestic macro. Especially, we have seen that Q1 FY25 we had some election-related impact on the capex. Then Q2 had the impact of say extended monsoon, and Q3 largely on the expected line. Though the expectation I would say had been muted. So net, if I have to say, from every quarters, whether it's a global factor, domestic factors, company specific issue, probably a lot of uncertainty, a lot of confusion, a lot of negativity, and it is also reflecting in the stock prices and the market in general. So you would have come across the word like reciprocal tariffs, which US is likely to say implement from April 2025. From India's perspective, US account for almost 17% of the exports. If we think about India's position, we should be relatively better off in case of electronics, pharmaceutical, home textile, and refining and others, because we have some benefit vis-a-vis say China. And looking at the anti-China instance of the US dispensation, probably these are the areas which should do well. These are the few sectors where say US companies are interested in, like they are having the rising presence in India, like electronics and IT hardware. It should also benefit. Then there will be the areas like tech, energy space, where the relationship between India and US is improving. Pharmaceutical, I mentioned that India is having a higher competitive advantage vis-a-vis China. In case of home textile, China's relative advantage is coming down because of the rising wages and so on. So these are the sectors which may be the potential beneficiaries over a period of time in next 4 to 5 years under the current dispensation in US. But at the same time, before the positive news, there is a slew of negativeness which we have come across. Like even in case of pharma, there are the concern regarding, say, US tariffs on the pharma industry. But when we get into the granularity of the same and try to analyze the situation, then India is the largest supplier of the generic drugs to the US, accounting for almost 40 to 50% of the supplies. If the tariffs are imposed, the pharma companies could pass the cost to the consumers and the insurers. And from the US administration perspective, they may like to avoid the steep tariff on the essential drugs because it will be having the direct impact on the US insurers and the patients. So if the tariffs are imposed, it may lead to the higher inflation and it may be very difficult to say substitute India supplies at India's cost. So while there are the noises and if I have to say there are the tariff threats as we speak, but over a period of time, ultimately the objective of the new government would be that US is better off, not the worse off. So at some point of time, more predictability, more certainty, and probably more logical conclusion will be coming across many sectors. There was another big event which happened in the beginning of the month, like union budget, and we would have already gone through in which area government is trying to do different stuff. So consumption side, there had been a boost, like government has announced that there will be, say, no income tax payable up to an income of 12 lakh. How we think about it, like all this incremental gain is coming to the people who are having income more than 7 lakh. And this bracket was generally doing well as far as the staples is being concerned, but discretionary consumption was taking hit for different reason. It may be inflation, it may be say slower economic growth and so on. Probably the discretionary consumption may get some uplift because of this incremental say cushion coming to the different taxpayers. And if that would be the situation, it may be, say, lower end of the discretionary consumption, it may be footwear, QSR. There may be some item where the people take the EMIs, like it may be two-wheeler, four-wheeler, say consumer durable, and so on. Net, we believe whatever the government has announced in the budget, it should be, say, a tailwind for the discretionary consumption overall. Next, there was big debate regarding the capex part. Like government has announced close to 11.2 lakh crore worth of potential capex in FY26. And when we compare the same on the revised budget estimate, then the number appears close to 10% growth, which is a decent number considering, say, overall nominal GDP growth, as well as we compare from the last year, the growth was only 7%. At the same time, the government is on its path to have, say, consolidation. The net borrowing number is expected to be lower on the YOY basis. So we do believe that they are the positive in the budget and the benefit of the same should be visible in FY26. If we have the retrospection for the 2024, we have all seen that it was a year of election, whether the general election and state-specific election like Maharashtra and so on. And then there was situation like climatic condition, that extreme heat helping certain sector and working against for many others. Logistic issue like Red Sea crisis we have seen, which had implication for global logistic costs for most of the companies across the world. We have also seen, say, Bangladesh crisis, and we also saw that many IPOs, QIP, OFS, a lot of money raising which happened in 2024. In terms of, say, return, as far as the stock market is concerned, there was divergence across baskets. Large cap did not do that great in 2024, while mid cap and small cap continued to trend what we have observed in 2023. In terms of sectors, we have seen that infrastructure, particularly the energy transition, circular economy, and EMS space did well. From the return perspective, H1 was decent, while the S2 it became quite tough, particularly from September and onward. Different issues, whether the global macros, domestic macros, started having impact on, say, stock market performance for various sectors. In the current quarter, the earning signals had been quite mixed. Going forward, we expect that the earning growth should pick up, particularly led by, say, decent marriage season, a good Rabi crop, as well as we do expect the government capex should also pick up. Reasons are like I have already mentioned that in Q1 we had, say, general election related issue, then Q2 we had the extended monsoon. So it's obvious that whatever the government has budgeted, it has to be get done, and we expect the trajectory should be relatively superior vis-a-vis what probably we have seen in the first half. If we think about the global market condition, India had been relatively worse off. It had been relatively underperformer, and we should think from the context like most of the other markets are close to their 52-week high, close to lifetime high, despite in terms of, say, earning growth prospects, economic growth prospect, India continue to remain an outlier from the positive outcome perspective. Like India is supposed to be among the fastest growing economies when we think from 3 to 5 years. And at the same time, inflation is also coming down. So macro perspective, ideally the India is relatively better off when we think from 3 to 5 year perspective. At the same time, if we think about stock market performance, it's happening other way around. Like most of the markets are doing good, and though Indian market appeared to be only 3% down as on 14th February, the number would have further increased as we speak. The correction in the mid cap and small cap space had been quite sharper. And there are various reasons. We will get into the detail of the same at some point of time. From the India perspective, the issue which is working negatively, like our currency was depreciating against USD, and whether 3 month and 1 year perspective, we did relatively worse off vis-a-vis most of the other emerging and the global economies. And the way we think about it, it's more like a mean reversion, like we were overvalued for a great deal of time. And now, after this currency depreciation, our competitiveness should come back, and so-called overvaluation should also go away. But think from the perspective of FIs, US investor, it's a US denominated return which matter. And when there is a currency as uncertainty, the first reaction may be flight to safety, what we have seen in last 6 months. There is significant withdrawal happening from, say, Indian equity market. Almost a $22 billion worth of equity had been withdrawn as far as, say, FIs are being concerned. And this is happening at the time when from macro perspective, there are certain positive developments are also happening. Like we all know, India import a large part of its crude oil requirement, and it's a big component as far as our imports are being concerned. And when we think about import, it does have bearing on current account deficit. It does have bearing on, say, currency depreciation. So from, say, that parameter perspective, crude oil is actually coming down, like almost 15 to 20% lower the number. And in the new regime in US, we will like to believe that there should not be any major upsurge given the focus of the new dispensation over there. In that scenario, our import bill should be relatively lower as far as the crude oil is being concerned, and it should not be a factor which should push down, say, currency incrementally. So this is a positive development. At the same time, we have seen the negative outcome that our currency is depreciating. So we will like to believe it was a correction overdue, which has happened to some extent, and probably next 3 to 6 months, a lot of clarity, visibility, and the stability should come in that area as well. This is a snapshot how, say, FI equity flows are working across emerging market. And as I mentioned earlier, that we were seeing the significant withdrawals. And in fact, from October 24, we have seen almost $22 billion worth of secondary market correction. And it is the number which is on the higher side when we compare with, say, rest of the emerging market over there. It is happening at the time while our domestic flows still continue to remain resilient. Till January, there had been inflows happening across baskets, and domestic flow had been quite strong, if I have to say so. This is the snapshot which give you the idea like what is happening at the current juncture. Like if you look different pool of Nifty 50, basically representing the large cap, and compare with the mid cap and the small cap. CY23, CY24, mid cap and small cap were doing relatively much better than the large cap. In CY24, the large cap was a Nifty 50 had only 10% up move, vis-a-vis say BSE mid cap would have moved by 27 to 30%. And more so, if we think about the scenario post January 25, we have seen almost significant fortune reversal. Like Nifty was only 3% down, and there is a lot of pain which is coming from mid cap and the small cap area, like almost 14 to 18% correction which happened in 45 days. Like this data is till 14 February. So in last 45 days, we are observing something which is happening after almost 2 calendar years. Though there can be some argument regarding say valuation, etc. But after the correction which we have observed in recent time, the valuation premium of a small cap particularly has come down dramatically vis-a-vis say large cap. And when we think about again medium to long term perspective, we will like to believe that a small cap as a pool should do relatively better earning growth vis-a-vis what probably we expect from the large cap. So a lot of correction happened, but it happened in the shorter interval, and it's having significantly higher intensity if I have to summarize. Why we are saying so? Like though the index suggests that we have close to 15 to 20% decline from its 52-week peak, but when we go stock by stock, more than 60% stock in the BSE 500 would be down more than 30% from their 52-week high. And the large part of the concentration is in the mid cap and small cap, like almost 60% mid cap and almost 70% small cap would be down more than 30% from their 52-week high. The same trend continue even the calendar year CY25. So largely whatever the correction we have seen, it is accentuated by the decline in last 45 days. And probably the things would have worsened in recent days, like again some mid cap and small cap correction we have observed. And it is happening despite the companies delivering decent growth in most of the pocket. So right now we are in a phase where a lot of indiscriminate selling is happening, and it's happening across sectors. Like if mid and small as a pool have come down by more than 30%, and that too we are talking about 60 to 70%, that means largely everything is coming down. Some would have corrected earlier, some stock and the sectors are correcting now, but we are in the time zone where a lot of uncertainty emanating from say either global factor or domestic factor, and currently anxiety level are higher, and which is reflecting in the stock prices. So we will like to believe it's not say sector specific, it's more about say segment specific, and it's more about that people just want to either cash in and just to address to the uncertainty. But at the same time, we will like to highlight that situation not always remain the same. Like you will recall in FY24, basically the time period of April 23 to March 24, PSUs were doing quite great. Like they used to be 10% of the pool and had risen by almost 90%, only one way up rally. In FY25, we have seen the role reversal is happening, and they are down by almost 7% as a pool. So at times, things go on extreme in one direction, and then the reversal do happen. So whenever the excesses are being built, then also the things come down. And when excessive correction do happen, then also reversal happen, which we have seen in different market correction cycle over a long period of time. There is always a pain time period, it may range from 6 months, 9 months, or a year, where the extreme do happen, like it situation may look like we have to just liquidate, sit on cash, and after that, when the things turn, at times we have the doubt, like whether it's a genuine bounce or whether we should continue to hold on cash and all those things. So extreme situation do play out in the market over a longer period of time. We have seen in last 30 years, it's only about, say, earning growth. If 12% earning growth had been the 30-year CAGR for the Nifty, almost similar had been the return by the market. In between, say, lead and lag event do happen at times. Stock market may move ahead of, say, earning, and vice versa also do happen. But ultimately, it's only about the bottom line over a longer period of time. Today, when we think about the valuation at Nifty level, we get some comfort that the current valuation are quite close to, say, 10-year averages. And so from valuation side, at least in large cap, there is not a big issue. The only concern which has resurfaced in recent time, that large cap as a pool, the earning growth have come down in about 25. Vis-a-vis what when we compared for 5-year period from FY19 to 24. At that time, even the large cap was growing in high teens, close to 17-18% CAGR. And in last 1 year, the number has come down significantly. But we expect that it should pick up in FY26 because it was concentrated in certain areas like oil and gas, and the benign, say, earning base will be also benign. Earning growth was even higher in mid and small. It has continued in many pockets and should be the case in future as well. We expect that mid and small should command a premium given their, say, overall earning growth potential over a long period of time. Currently, because of different reasons, the correction is happening, but it will also stop at some point of time, and earning growth will be again the driving factor for either the valuation and the stock return. If we come to, say, golden decade and the India Vision portfolio, in FY24, we have argued that chemical sector, consumer discretionary sector were pulling down the overall performance. At the same time, FY24, say, PSU as a pool moved by almost 90%. And if I have to summarize, they accounted for almost quarter of, say, benchmark performance in FY24. And now the reversal is happening in FY25. So things go on extreme in certain durations, but at the same times, ultimately, it's only about fundamental over a longer period of time. There are certain areas which have done relatively better for us in FY25, whether it's a telecom, something like circular economy exposure, staples like Patanjali, beverages like Redico, and so on. This is a snapshot of the companies where we have made entry and the exit. If I have to go through the recent entry, then Dixon, Keynes, Newland, Senco Gold, these are the recent entry where we have started building the exposure in January. So we have seen these companies were going through the correction and we started taking some exposure, though they had been further correction in these stock, but we are quite positive about the potential of the earning growth coming from these companies. Like Dixon, for that matter, this is the representative of the manufacturing story, make in India story in India. And when, say, global players were looking for China plus one example, this is a company which benefited most as far as the PLI scheme, which government announced about 4 years back. And the benefit of the same is visible in terms of, say, revenue growth, earning growth. This company is delivering and can deliver. Like 12,000 crore was the revenue in FY23, and the expectation is in FY26, the number will become almost 59,000 crore plus. So within 3 years, it's becoming 5x. And we expect that this company can deliver almost 40% plus earning growth for next 5 years. There was sharp up move in the stock market, a stock move quite handsomely. And after that, given the uncertainty related in the, say, global market, domestic market, some correction also happened. So we have started building some position in this particular area. Next is Keynes. Keynes is also in the EMS space, similar story, like it's a player which is providing support to many sectors, whether it's automotive, industrial, aerospace, defense, outer space, and also getting into the new areas like whether it's OSAT and high density interconnected boards, etc. So opportunity size is quite big, and we again expect that this particular company can also deliver, say, almost 40-50% revenue growth, earning growth for next 5 years. If we look the historical trajectory as well, like 1100 crore used to be the revenue in about 23, and by about 26, the number will be almost 4 to 5x. So the way we think about it, from FY19 to FY24, the earning growth was quite broad-based, like it was happening across segment and across sector and happening for most of the companies. But going forward, our expectation is that there will be certain set of companies which will continue to deliver strong earning growth, and there will be huge divergence. Like there will be certain pockets sustaining the growth momentum, while others may have significant correction as far as say earning growth projections or the potential is being concerned. So we are taking the exposure towards the company where the visibility of supernormal growth is very high. Next is Newland. Newland is having two components. One is say they provide the APIs. This is close to almost 50% of the business, and they also do say contract manufacturing for API innovators. If we think from the perspective, the growth visibility, again, this will be, say, one of the fastest growing, say, pharma companies. We expect that almost 20% plus revenue CAGR from the current portfolio. In fact, in FY 26, there will be commercial launch in one of other product, and then there can be a potential of another launch in FY 27. Net from 2 year perspective on FY 25 base, the earning growth may be 35% plus CAGR. The stock has seen significant correction, like it used to be 18,000 plus. We started taking some position between 13 to 14,000 after significant correction. Though the stock has come down further, we have a small exposure in the name, but from say growth trajectory perspective, again, this can be area where significant growth is possible. Next is Senco. Senco, again, very small position is being taken. So in case of Senco, if we think about like this used to be a regional player where very strong presence in the eastern markets in India. Now they're building their presence in northern market. In terms of the growth potential, they have delivered almost 20% plus revenue growth, and we do expect that the number should continue even in future. So we expect next 5 year perspective, again, this company can deliver 20% plus revenue growth, and it may be again on the higher side in the consumer domain itself. But the stock has taken a beating for the reason that if we think about Q3 FY25 performance, there was twin impact. One is a custom duty impact, almost 57 crore of the custom duty impact this company has seen. But this was standard across the jewelry sector. Titan also experienced a custom duty impact of close to 450 crore plus, and so was the case with Kalyan. So everybody saw the custom duty impact in Q2 and Q3, given say custom duty was cut from 15% to 6%, and this sort of inventory correction impact do happen. Second part is, which is more company specific. Last year in Q3 FY24, the company had hedging gain that was close to 68 crore, and this quarter is just a reversal of the same, like almost 68 crore loss. But please understand, it's a hedging practice where the things neutralize over a period of time. When we think about 9 month perspective, it's more of a timing issue. So in certain quarter, these number may look at extreme, but over a longer period, ultimately it's hedging to protect say underlying business. So business margin had been intact. It's more about hedging, which reflected on the poor number as far as the reported number is being concerned. From Q4, again, we expect that revenue growth should again be 20% plus, and the EBITDA margin should again go back to the normal trajectory of 7 to 8%. And about 26, we expect the similar sort of trend, like almost 20% revenue growth and 7 to 8% EBITDA margin. So currently, weak performance in optical terms in combination with the uncertain environment, and particularly extreme adverse environment for small cap, mid cap, and micro cap, there had been sharp correction in this particular stock as well. This is a positioning which we have seen over a period of time. Like we have increased our exposure towards, say, manufacturing, infra, because we believe this is a story for next 5-10 years. It's not about a particular year, and this area can still generate a significantly superior earning growth for a long period of time. We remain overweight in the consumption side, consumption area, and we are having large position in the discretionary consumption side. We expect, given the budget outcome, that is the area which should benefit. And then other areas like telecom, etc., we have a decent position. We have tried to build the position in the healthcare side, and the energy side, and utilities, and so on. This is a snapshot, like vis-a-vis, say, benchmark. We are significantly overweight in infrastructure engineering. Again, we believe it's not about a year or two, it's more of a longer term story which should stay. And again, we are overweight in the consumption side. In case of pharma, I have already mentioned, we have built the, say, weight in recent time and further building in that area. The market cap is quite important issue which we have to take into consideration. Like as on 31st January, say the market cap was close to 40% in large cap, and balance was more and mid and small. And in fact, if you look the trajectory, the, say, exposure towards, say, mid and small increase in last 1.5 year. It was not driven by, say idea that we have to be in mid and small. It was more bottom up, like we want to be in certain areas, we want to be in the emerging leaders. I will just give some example, like our major say small cap exposure is in the areas where the companies are having distinct advantage and potential to deliver quite a strong growth for their capability. Like Radico Khaitan had a very strong track record of delivering, say, quite a strong earning growth and stock return as well. And we expect that it should continue to do so for next 5-10 years. Like we expect again 20% plus earning growth. But at the same time, as I mentioned, that currently anything which belonged to small cap, mid cap, micro cap, there had been sharper correction. So stock used to be close to 2600 plus. It has come down to 2000 something, though it has delivered almost 25% plus earning growth in the current challenging environment when everybody is talking about the slowdown, and we expect this trend should further accelerate. Okay. Second is like something like Gravita. Gravita is the champion in the circular economy. Like if today we think about recycling, ESG as a theme, it's a global theme, and Gravita is the largest player in that area. The company was delivering anyway 25% plus earning growth, and post the recent money raise, we expect the company can deliver 25% plus volume growth for next 5 years and close to 30-35% earning growth. The trend continue even in Q3, and we expect that it should continue for many years to come. But at the same time, we have seen the stock corrected from its peak of 2700 to close to 1650 as of now. Why I'm highlighting all this thing? Right now, it's not about merit or demerit. It's more about, say, segment, and indiscriminate selling is happening. At the same time, we have seen in many cycles that whenever some sort of stability come back, sanity come back, the strong thing is those things rebound quite fast. So while many things can go down together, but not everything can come back. It's only, say, fundamentally strong companies, they make a strong reversal whenever some sort of stability do come into the picture. Currently, we are living in a time where everything is happening at quite accelerated fashion, like whether the up move or the correction. And today, it's just the correction which is happening, and it's happening across the basket. I've taken two different examples in two different areas. Third may be company like Transformer Rectifier. That company, we have taken the position during QIP at 655. Then the 1:1 bonus sort of issue happened. So effectively, you can say 300 plus. In FY24, the profit was 40 crore. In FY25, the number may be close to 190 crore. In FY26, the number may be, say, close to 290 crore. Basically, we are talking about step jump as far as the profitability is being concerned. In Q3, when the company announced, there was 200% plus earning growth happened to be in the first week of January, you can say. Stock made lifetime high, new high, and if you compare with the current prices, it used to be 650, and currently it would have come down to close to 450, and that too after having some say reversal happening. Otherwise, the stock had been down by almost 50%. Again, I'm trying to highlight only one thing. Current is the situation when everything is coming down. But the moment some say predictability, some stability comes, the reversal also happen quite fast. Like in case of Trill itself, during the mid-February, the stock touched the bottom of close to 360 or so, and the moment some predictability came, there was 20% up move within short period of time, and that is going to happen with many stocks the moment the first sign of stability do come into the picture. As I argued earlier, that stock return, portfolio return is an outcome, and they are dependent on the earning growth. So that is an area that most of our companies have delivered in past. Like even in Q3 of 25, when we would have come across through many quarters that people are talking about slow growth, multiple issues. Our portfolio companies at an aggregate level have delivered 19% operating profit growth, 20% plus sales growth, and 25% PAT growth. And this is not specific to this quarter. This had been the trend for 9 months about 25. Full year perspective, we expect the earning growth should be more than 20%. And you should compare the same, what is happening in the say, broader market or at the large cap level. Because this had been the reason to have a more exposure to our mid and small, like large cap earning growth have come down dramatically when we compare to previous 5 years. And even in future, the potential is going to be relatively lower when we compare to the mid and small. So in FY25, our portfolio should deliver 20% plus earning growth, vis-a-vis say 5% in Nifty. And in FY26, we expect the number should further expand to almost 25% plus. So this is the agenda which had been delivered in past, is getting delivered now, and should be the case in future. This is again a snapshot how our companies have delivered earning during FY19 to 24, and what was the outcome in terms of the stock return. So if you look FY19 to 24, the aggregate earning growth was almost 30%, and Nifty would have delivered 15-16%, and large part of that would have converted into the stock return for the respective companies. Like certain companies would have come late in the portfolio, but whenever the earning came, it did translate into the stock return. In FY25, these companies continue to deliver earning, but at the same time, we have seen significant correction in the stock, and we expect that it's an opportunity rather than getting too much concerned about it. Like these are the companies have a very strong track record to deliver on ground, and in future, whenever say some sort of certainty is coming back, stability is coming back, the appreciation of these companies should again come back. This is the psychographic, like our portfolio is combination of high earning growth as well as high return on capital employed. This is generally a rare combination. Like generally what happen, they are the mature companies which may be delivering higher ROC, but the earning growth profile will be relatively lower. And there may be another set where the P&L growth may be higher, but return on capital employed may be lower. In our case, we have always stick to this high quality, high growth, and this combination of a high earning growth and high ROC profile. What happened in last 3-4 years? I have argued even in past, and I'm saying the same again. Like though it had been quite some time from CY21 to you can say till date, 3-4 years in a row, growth as a style has not worked. Like you have seen from October 21 to almost CY23, there had been only one way up move in the interest rates. And whenever it happens, it's a negative news for, say, growth economies, growth sectors, and the growth stocks, and the negative news for our style. And current valuation, if I have to highlight, the current valuations are much lower vis-a-vis what probably we have seen at any trough in last 4-5 years. like the valuation level, what we have seen in COVID-1, then the valuation level in COVID-2, then Russia-Ukraine. Current valuation is almost 20-25% lower. And today, we don't have any existential crisis. Today, we do not have any financial crisis or say credit crisis, etc. It's only about multiple factor, multiple noises, right from say rest of the world as well as our own factors. Everything is getting compounded and leading to the current situation. So companies continue to deliver earning, but at the same time, it did not translate into the commensurate stock return because our style itself was not a fashion. But it's going to change. And why I'm saying so, like in February, we have seen already first interest rate cut has happened in case of India, though this cycle has started, say 6 months back for rest of the world. And whenever the interest rates are coming down, it's a positive news for growth as a style, or at least it will not be a drag anymore. And if that is the situation, then in the stable market, theoretically, the earning should translate into the stock return. Though I would have said the same thing sometime back, but right now, since last 45 days, it's only one way down, which we are observing in the broader market. And currently, to highlight that when this thing will change, it's very difficult to pinpoint. But we have seen even in past, irrespective what happened in last 25 years, and the most of the major issues, whether it had been say Asian currency crisis, tech bubble, financial credit crisis in 2008, then 2013 taper tantrum, and then say demonetization in recent times, say COVID, etc. Most of the time, these issues maybe they are 6 months, 9 months, but after that, whenever the reversal happen, the reversal is also equally quite ferocious. Like at times, it's very difficult to pinpoint the bottom and very difficult to pinpoint the top. But it's more about method and the process. Like we are just looking for the process part that the company should deliver earning, and ultimately, last 30 years we have seen as long as it happens sooner or later, it do convert into the stock return as well. This is a snapshot of the say companies which have done well. So Bajaj Finance, again another example, which the stock which was not doing well for a great length of time, and many people would have said many things about it. But ultimately, we always said that this company is delivering 25% plus earning growth. It is outlier. It's not a norm. What happened in between? There were many companies on the PSU side, etc., which started delivering decent number for some point, some period of time. Then we started saying that it's a growth convergence is happening. Why it should command premium? Why others should not re-rate and so on. But there is a difference. They are one-time wonder, and they're the people who deliver on the ongoing basis. And the people who deliver on the ongoing basis, the sooner or later appreciation is bound to happen. Like even in case of Bajaj Finance, the stock was not doing good, though it was delivering numbers. And in last 45 days, when the market is crashing left, right, center, the stock is up 25%. So things do happen. At times, the patience is required. The only thing I can say. This is a snapshot like till January. The January was a brutal month, like almost 9% correction. It was more attributed towards the mix, like mid and small Cape Town heavily, and it did impact the overall performance, not only for the month and the full year as well, because when the month is not good, it impacts everything. At the same time, February also continued on the same trend for till mid-February. Then there was some sort of stability. And again, today, extreme reactions are happening in the mid and small cap space. But we are saying that wherever we have invested in, those are the companies have their own right to do well as far as the fundamentals are being concerned. The moment the things will stabilize, the fortune reversal will be equally fast. This is something we believe in. Currently, the risk, what probably should be watch out for, it may be say high crude oil from the geopolitical situation. But as I argued earlier, the current dispensation in US, looking at that, crude oil should be range bound. The more material part is like how the US policy would be and its implication for India and the rest of the world. And if the overall global economic growth come down for the frictions what we are observing globally, it's going to implication for everyone involved. So I will stop over here and happy to have any question which you might be having.
Sure. Thank you, Kuldeep. I'll request you to pull down the presentation so that our faces are visible to the audience. So, audience, please feel free to type in your questions, and in the meanwhile, I'll just let Kuldeep pull down the screen and ask a few questions that I would have curated. So, Kuldeep, just stop sharing if you can.
Okay.
Yeah, perfect. So Kuldeep, the first question that comes to my mind, while we were discussing the portfolio is that there has been a divergence between earnings and the share prices for our set of companies for a while. And obviously January month was brutal where it took away a lot of gains made in the year. So going ahead, a couple of questions there. What is or what are the pockets that you will probably avoid going ahead or continue to avoid if you were avoiding earlier? And the second is, what will, when do you think that this kind of extreme uh, reaction to either on the upside or the downside will kind of moderate? And, the question more direct is, when do you think our performance will come back? So if you can just take those two answers questions.
So, so I try to touch upon the same thing. Generally, the style issue do not last that long. But what happened from almost you can say fag end of the CY21 and till date, there had been either up move and no correction as far as the interest rate is being concerned. And the intensity you can think of like the event was happening with such a quantum after probably many decades, like we have seen the scenario after 30-40 years. Okay. And two things happened, like one, it was global issue and everybody started talking about say value versus growth. And we have seen that this issue work this way only, like there was 4 5 year period of up to say COVID, you can say, or up to CY20, you can say, where the value as a pool was not doing good because the earning was a missing element. There were multiple issues, whether it's a PSU as a pool or in general. And that area was not working at all. While the growth was coming in the growth pool, it was getting appreciated market, and the divergence was happening at another level. Then this interest rate cycle, which I mentioned, probably one of its kind in last 30-40 years. Generally, this style may be having its extreme at 1 year, 2 year, but not of the kind what we have seen. Like last 3 year at a stretch, that quality and growth as a pool did not work. Okay. And that had been our positioning. Like we have always argued that the people have different style. There are the people who practice value, there are the people who practice contra, there are the people who practice growth. We practice quality and growth. And style was not in fashion at all. Today, I will like to believe from style perspective, whatever was a headwind, it's getting away. Like today, we are talking about interest rate coming down, inflation coming down, and whenever it will happen, it should help say growth style, our own positioning, etc. But what happened? This happened at the time, like the first positive news of the interest rate cut came this month after a length of time, I would say after 3 4 years. But it happened at a time when multiple factors playing out in tandem, like where the global negative noises, whether it's domestic related concern related to capex and overall slowdown. So we couldn't appreciate like the changes are happening and the benefit of the same couldn't accrue. But the point I'm saying, we have seen these extremes in different cycle, like massive correction happen in short period of time. But ultimately, the moment the stability comes, the people appreciate only the earning growth part. So right now, if I have to say, we are working on one extreme, and which is not conducive for the overall market, forget about value growth or anybody. And as I mentioned, today almost 60-70% stock would be down more than 30% from their highs. Okay. So everybody would have suffered in different proportion. Mix also plays its role. Second point, I mentioned that in every bull market, there are the different stars. And when the correction happen, steep correction happen, not everything come back. But they are the people who are able to show durable earning over a longer period of time. They do bounce back. And this is a part I was trying to highlight, that our companies over a longer duration have delivered strong earning growth. It did translate into the respective stock return as well. But in recent times, though they continue to deliver earning, because of say current situation of the equity market, concern, sentiments, whatever you call it, it's working other way around. Like the appreciation of that earning has not happened. I'm saying based over say the interest rate downward cycle, what we have started observing, at least so-called macro parameter should not work against. So far, it was working against the style, like interest rate moving up, it's leading to a
Understood.
delay.
So Kuldeep, on the paucity of time, we understand, we appreciate the fact that factors have been working for our companies who have reported high ROC as well as growth to come into play and deliver share price performance as well. The second part of the question that I was trying to understand from you is what sectors or what pockets do we still avoid? As you said that the breadth of the earnings will narrow, and therefore it becomes critical to avoid where there'll be normal or subpar growth. So just to understand, which will give an idea to our investors.
So it's more about within sector, there can be two subset. Like in consumption, there is a staple, there is a discretionary consumption. We are more tilted toward the discretionary consumption, where the earning growth potential can be 20% plus, vis-a-vis staple, where the earning growth potential may be single digit. Within BFSI, we are more tilted towards say NBFC side rather than the private banks or the PSU, where in those names, the earning growth may be low double digit, mid low teen, while in NBFC space like Bajaj and Chula, the number may be 25% plus. So within sectors, there are different baskets are available. So we are tilted to more towards a high growth basket, if I have to say so. And same is the case like IT, probably the growth trajectory had been perennially lower, and we do not have presence in that particular area. So we are in the areas where the growth is there, and we are avoiding the area where the growth is a missing element.
Right. So appreciate that. So we have questions on the performance, of course, and that Kuldeep answered. What I want to understand, Kuldeep, from you is the Golden Decade Fund and India Vision. What is the positioning of the fund, and what kind of investors do you think should look at a portfolio like this? Or what is the USP of the portfolio right from the manager's mouth here?
So we always say it's on the value migration theme, like a country offers certain earning growth, and within that, there will be the sectors where the earning growth potential may be relatively higher. So we want to be in those areas. We are not thinking from a quarter or year perspective. Wherever the durability of that growth is higher, we want to be in all those areas. Those may be unorganized to organized transition, or there may be multiple factors. In nutshell, if India is going to grow at certain pace, our portfolio companies put together should be able to grow at double the pace, if I have to say so. So that is basic the idea, like growth orientation, and should be able to benefit from say economic growth in this country.
Right. So thank you for that. I think that will help a lot of investors understand the purpose of this fund and what we're trying to achieve here. I'll come back to a question on consumer discretionary. Uh, Obviously, there has been a event which might lead to more consumer discretionary spend. You touched upon it in your presentation with our positions in Senco. We also have a Varun Beverage and a few other more pointed consumer discretionary names. What is your whole view there, and what are you trying to include more sectors there, such as automobiles or certain consumer services? How do you as a fund manager want to pick up names there?
So we had been always overweight in that particular area. And as I mentioned, it's more tilted in favor of discretionary consumption. Discretionary consumption was taking a hit because of, say, urban slowdown for a good length of time, almost 18 months. Not much happened in that particular area. And we expect from FY 26, like when the people are having surplus, there should be additional income, there should be cushion available, and that area should do well. So we were relative overweight in that particular area, and it should continue to be the case in time to come.
Right. And before we conclude the call, one of the largest allocations in the fund has been manufacturing, infrastructure, and allied sectors. What's the view there coming off the back of the budget? You did mention that the incremental allocation to budget, capital expenditure and infrastructure looks very healthy and promising in the budget announced. What will you be expecting here? And typically, do you think these will be reporting high growth in the coming few years? We've heard about Dixon. So, we will talk more about, more capital goods and infrastructure in the real sense of it, if you can just throw some light there.
So Dixon Keynes, I have already touched upon. Then I also mentioned about transformer rectifier because we believe this theme will continue to play out for next 5 to 7 years. It's not India specific; it's a global theme. What happened? Like currently, extreme things are happening in that particular area. Like you would have seen, say, Polycab, KI Industries have corrected significantly today, just because Ultratech has announced its entry in the cable and wire space and more limited to, in our understanding, towards the wire space. If you think from the perspective, wire is 1/3 of the portfolio for both of these companies. These companies are primarily cable companies. 1/3 of the company, a new entrant come to the picture, announce certain capex. Probably it will take 2 to 3 years for that capex to come on stream. Probably 4 year, 5 year down the line, the industry will be having a new player in some one way or another, but impacting 1/3 of the business. But today itself, we have seen almost 20% of the reaction. Okay, so you can say whatever these people would have created over decades in the wire domain, almost 60% of that value have gone in a single day because of this particular announcement. We will like to believe it's quite extreme, which is happening at the current juncture. So within CapEx, the same thing, like people may have certain expectation, but 10% growth on the FY25 base is still a decent number. We are not talking about a muted growth or cut over there. We are still talking about decent growth. And there are certain pockets where only that much can be taken. We are still talking about 13% growth in, say, defense side. And there are the other areas like whether railways, etc. There is a limit how much the sector require. So there can be genuine allocation, but at times we overread in certain things. We expect top down, there should be decent capex happening both in the private and the PSU, which should help that particular exposure. So earning growth, we do not foresee material, say, fortune change as far as these companies are being concerned.
Right. So Kuldeep, thank you for that. And that gives a very, very healthy idea on where we see CapEx going or CapEx-led investments going. So the last question that I'll pose to you is on the hindsight. It's a more philosophical question. On hindsight, we see Jan as a month of steep correction and taking away a lot of gains for the FI for the calendar year previous to that. Do you think there's a way that one can mitigate it, having obviously the advantage of hindsight here, and if there's something actually that can be done to prevent the effect of such extreme reactions in the market?
So the only thing which has played out from January beginning is the mix. Like somebody who is having large cap tilt, they are relatively better off. And somebody who is having more tilt in favor of mid and small, they have taken the better. And not much can be done about it. Like why I'm saying so, like CY23, 24, same valuation concern, everything was going on. Companies were delivering, getting appreciated. And today we don't have any existential crisis. We don't have any credit crisis. We don't have any financial crisis. It's only the noises which are coming from different quarters, and probably the extreme reactions are happening towards those noises. So if something is working for 2 years in a row, and please understand, as I mentioned earlier, it was not about a mix like mid and small we want to be. It's more about, say, bottom up. We want to be in recycling area. We want to be in alcoholic beverage area and so on. The emerging leaders. Right now, there's no distinction happening. Like everything is coming down. It will not remain the case. So we came for the growth. Growth is happening even as we speak. It's only about the appreciation of that growth has been for length of time, not happened for January and February. But I don't think it's a permanent stuff. Whether 6 months, the things have to come back. I don't think there's any other way around.
Right. And I'm sure they will when we have this quarter early call again in a few quarters. I'm sure we would be sitting with much better price performance. And thank you for that to the participants. Thank you for that, Kuldeep. Stay tuned to our further such quarterly calls on our portfolios, and do follow us on YouTube for all our previous webinars. Thank you. Thank you, Kuldeep.
Thanks, everyone. Have a good day.